Hello, everyone. We're going to start our presentation here. My name is Chum Strube. I think I've met everybody here, and welcome again to our December Clubby St. Paul Luncheon. Just a couple announcements for our events. After the holidays, we start off at the Minneapolis Club Thursday, January 10th, and Rick actually hosts that. He's back there if you want to ask him more questions or want to get on his list. And the topic will be buying and selling things online. We're back here in St. Paul, January 16th. Dr. Terry Wu will be sharing what neoscience marketing is. Our luncheons are sponsored by our partners, the University Club, Olsen Thielen CPAs, a regional accounting and consulting firm, the Irish Titan, an e-commerce digital agency, and my firm, Legal Shield, providing employee benefits in identity theft and legal protection. I'm really excited about our speaker. This is the second time she's been with us, and she's spoken several times at the Minneapolis Club too, at Rick's event. She's very dynamic, and she is very accomplished, so I had to cut her accomplishments in half. So this is the shortened version, but you'll see how smart she is when she begins speaking. So she is the CEO of and chief whiteboard artist of Distill, an insights and advisory company to C-suites and boards. During her 20-year career on Wall Street as a stock analyst, Neely would routinely apply seemingly imperfect and disparate data to help ground conversations about consumer behavior to money managers and institutional investors. Neely led the consumer research practice at Piper Jaffray and is considered a consumer behavior expert with insights that span all demographics and across all key areas of discretionary spending. Please welcome Neely.
Thanks. Okay, we're going to move this guy to the side. There we go. Today we are going to talk about the consumer economy. That's what we're going to do. That's really what we're going to do. And we're going to talk a little bit about navigating that consumer economy, because it's actually really simple. If you have jobs, typically spending shows up. Okay, that's what happens. If you have jobs, spending shows up. But there are some forces that can be at play that can disrupt that very happy little pattern. And so what we're going to do is unpack some of those potential disruptions. But really what you're getting is a taste of how we talk with our clients in the boardroom. We're just coming off of our boardroom series. I have Kayla here with me, who's co-founder to Distill. We've worked together for 8 years. And it's been a vibrant and lively boardroom season so far, okay? All right, so, I gotta turn this thing on. Good time to put up my disclosures. This is not investment advice, people. Anything I say can, in fact, harm you. So please consider this a conversation and only a conversation. Okay. We actually think, did Martha make it here? Is she here? Okay. Like one of our lawyers was like going to be here today, so I definitely had to put that thing up. All right. All right. So there's me. There's Kayla. We were on Wall Street for 20 years. And what we did while we were on Wall Street is we helped money managers invest dollars. We focused specifically on the consumer sector. Kayla and I did that again together for 6 years. And 2 years now we've been at Distill. We left Wall Street very amicably and decided to start our own practice going into boardrooms. We work primarily on retainer basis. We do some project work, and almost all of our clients don't live here. They live elsewhere, like New York, California, Chicago, Nashville, things like that. But that said, if there's anything here that triggers a conversation that could be helpful to you to do like a one-off meeting, we'd be very happy to entertain that sort of conversation, because we have a soft spot in our hearts for our local friends, okay? All right, here's where we're headed today. We're going to talk about the consumer health, the status of consumer. We're going to talk a little bit about some consumption shifts that we are identifying ahead, which might kind of be a little controversial. And then, of course, what we're calling the holiday table talk, right? You're headed into the holiday season, and you're going to be sitting around, and you're going to have conversations with families. What will you be talking about as it relates to the economy around the table? We're going to give you some of the talking points today, okay? All right. First, how is the consumer doing? And why does the consumer matter? The consumer matters because the consumer is 2/3 of our economy, right? You often hear that phrase, consumer spending is 2/3 of the economy. We're going to show you exactly what that looks like and why. There's three kind of metrics here. We've got retail sales, which is about $5.76 trillion in size, and that's about half of what they call personal consumption expenditures, which is code for consumer spending. That figure is 2/3 of GDP. GDP is gross domestic product, and that's basically the measure of our economy. Or an economist would crucify me right now if I said this, but like kind of the revenue, right, of our nation. You want it to go higher, that's good for us. If it goes lower, it's not good. Like most things financial in life, more is better, right? Okay. All right. So we're going to talk a little bit about that retail sales and that consumer spending, the PCE piece today. How has consumer spending been? Interestingly, not spectacular over the last 10 years. When you look at personal consumption expenditures, the long-range average for personal consumption expenditures is closer to about 3.3%. That's that pale blue line. For all of our color challenge trends in the mail industry, we've learned to not do red and green. Okay, so keeping out of the holiday spirit. But we do have a faded blue line and a dark blue line for you today, all right? The faded blue line is the 70-year average, 3.3% of personal consumption expenditures. For the last 10 years, we've largely been below that level. What has been causing some market excitement lately, though, is the second and third quarter of this year, we saw a positive inflection, a positive move in consumer spending. And that got people really, really excited. Because remember, so goes consumer spending, so goes the economy, right? It's like a leading indicator to how the economy is going to be moving. So the question here is, will it hold? Right, here we are in Q3. It's starting to move towards the positive average. It's starting to move higher. Is it going to hold as we head into 2019? Right? That's a very fair question. Well, in order to know if it's going to hold, we have to actually dissect what it is that consumer spending is. We ask two very basic questions of economic data, right, to come up with consumer spending. Does the consumer have cash? Do they want to spend it? Right? It's two very basic questions. And almost all economic metrics can be boiled down into those two questions. Do they have cash? That is a very calculable, sort of quantifiable question. Usually moved by things like jobs, wages, what are the headwinds to your ability to spend, inflationary costs, right? Gas prices, food prices, things you see on a daily or weekly basis. Home values, right? Stock market returns. These are all, how do you feel about your balance sheet, your personal balance sheet? Does your home have a lot of value in it? So if it does, you might actually feel a little bit willing to kind of extend yourself a little bit, knowing that you have that in the bank. Do you have good 401k, retirement money, right? Again, if you feel good about that balance sheet side of your life, you might actually extend. Today, we're only going to talk about pretty much a couple of factors on the employment and wage rates sort of dynamic today. But then, do you want to spend cash? I'm just going to make a couple mentions about this. Do you want to spend it? Is it a priority in your life? Do you need to spend it? Are you confident in spending it? On what categories do you want to spend that? That's the art side of what it is that we do. The science side, easy to figure out. The art side is where we spend a lot of our extra time. All right. So, jobs. We have jobs. Like, that's a really good thing. That's a good setup to consumer spending overall. Jobs are, again, like all things financial, more is better, right? That's the first chart you're seeing over here. The number of employed is on the rise. But interestingly, wages started to kind of tick up a little bit too. Anybody here employ people? Yeah, you're having to pay them a little bit more, right? Because that's what's happening. Labor costs are going higher, and that's driving wages generally on an upward trend. And it hasn't been that way for a while. But if you looked at just jobs or you just looked at wages, you wouldn't be able to really understand, like, well, does there more dollars to be spent in the economy? So we bring them together, we actually make a product of number of people employed and wages to come up with something we call labor force income, right? So what is the actual income capacity of the nation, right? It's been up about 4% on average annually since we've had the recession. And in last year, we ended the year pretty decently strong, up 4.7%. So one would surmise that if the overall labor force income is up 4.7% in your pocket, you can spend 4.7% more dollars, right? That's just kind of the way to think about it. And in fact, retail sales in Q1 last year was up 4.6%. Okay? That's what you're seeing right there. So as you headed into this year, your income was pretty decent, and your retail sales, remember, that's that half of the consumer spending, right, sort of square. It was up 4.6%. But then Q2 happened, and this was pretty astonishing. Q2 was up 6.5%. You don't see moves like this in retail sales. This is unusual, okay, to see huge jumps like that all of a sudden. It was up 6.5%. Jobs didn't just jump up in Q2, and wages didn't just jump up in Q2. So Kayla and I started digging deeper because we're like, this feels a little exuberant, right? You have some local CEOs of publicly traded companies saying things like, this is the greatest consumer environment ever. And we're like, it really wasn't that different from Q1. It wasn't really that different from Q4 last year. What changed in Q2? Well, we all know, hopefully we all know in this room, and if you don't, you're going to know by the end of the day, the tax policy changed, right? The Tax Cuts and Jobs Act of 2017 was passed in December last year and generally implemented in withholding tables in February of 2018, this year. Okay, so why does that matter? It matters because the way that employers were required to withhold your tax dollars changed. And so everybody started seeing a little bit of extra dollars in their pocket from their paycheck, okay? But the pattern of how it got withheld is what is particularly frightening to us, okay, in hindsight. And I'm just going to give you this one little heads up. The Treasury, the United States Treasury, big deal, right? They publish a document every single morning called the Daily Summary, okay? You're shaking your head. You know this document. Woohoo, girl power. Okay, we know this document. It's a 2-page document. Anybody in this room could go pull up, like we did, this document and calculate the withheld employment income taxes line item on a daily basis that shows up in the Treasury's coffers, okay? They have to report it. Your tax dollars require them to basically report it. And so we did that. And interestingly, we saw that the Treasury was withholding significantly fewer dollars in Q2. That's what you're seeing here. So the Treasury was withholding $4.2 billion fewer dollars in Q1 because of the tax cuts change, right? Employers were told to withhold differently. But in Q2, for whatever reason, because we can calculate it, that number jumped up to $23 billion. Interestingly, $23 billion is about 85% of the increase that we saw in Q2, right? Are we all tracking here? So FQ2, the difference between 4.6 and 6.5% is $27 billion. That $27 billion was largely funded by the changes in withholdings. Let this sink in, okay? If you're planning a business right now and you had a really good Q2 last year, have a little caution going into this year's Q2. We clear? All right. Check your withholdings. Try to make a Hail Mary pass on your withholdings overall. Because it's not just the timing, it's the overall dollar amount that we're worried about. We calculated it from a bottoms-up analysis. We spent an insane number of days and hours doing this because we're nerds. We actually calculated what the average tax savings from the tax code would be. and we weighted it by adjusted gross income, and like we had so much nerd fun doing this. We came up with 1.7% average tax savings, and we calculated this in December, right, of last year. Okay, she's my truth teller, which is why I look at her. Okay, all right, and we could have waited till the Joint Policy Tax Center or whatever came out with their estimate in March. They said it was 1.8, but we got it like 4 months earlier because we calculated it. So that's cool. 2 chicks and a calculator. All right. So, but what's frightening about this is the average savings on an adjusted gross income basis, right, is about 1.7%. Year to date, like through 2 days ago, the Treasury is withholding 2.8% fewer dollars right now. It should only be 1.7, right? We're already feeling that kind of tension. Like, is this going to end well when people file their taxes? No, it's not. In fact, here's a daily, this is the picture. This is what we calculate. This shows you a daily flow of what the withholdings are. And you can see it's widening as we're gliding into the final days of this year. I know, it's the why. Steve, let's pause right now and ask the why. We think the primary disconnect, the Tax Cuts Jobs Act, great idea, okay? Actually, we're big fans. Sorry if that offends anyone, we're big fans, okay? I don't like paying taxes too much. You shouldn't live in Minnesota. But very poorly executed. In fact, because I'm going to answer your question, because I know you're going like, what? How did this happen, right? Because they removed the personal exemptions, right? Okay.
This is what I was going to ask you about.
It's the personal exemptions. Because how people withhold on their sheets, their W-4, was based on a personal exemptions based, you see what I'm saying? Okay. And unfortunately, it is the employed's person's responsibility to know what's being withheld from their taxes. And we have actively been talking with our companies, like, push out a new W-4. That would be a great idea. You know, like making sure people are touching base with their withholdings. And we're not alone in signaling this. Even the GAO, okay, it's the General Accounting Office, right? Accountability, thank you. The Accountability Office, the Government Accountability Office, okay, that's the name of it. They're basically like the compliance department, right, to the United States. And they published a study on July 31 of this year that said, hey, so we're just gonna ask, like, what are maybe the policies and procedures of calculating withholdings? I mean, they asked the IRS to basically come forth and say, we're gonna need to see in print, like how things actually got withheld and calculated, okay? It's a real document. You go find it. We actually have links to it on our LinkedIn article related to this. It was so important to us. Everything we keep behind the paywall, but this concerns us so much, we've put it all out there in the public domain as much as we possibly can. Okay, so if you have any follow-up questions, you can go to our LinkedIn profile, and we've got links. But the IRS followed up 6 days later, 9 days later with like multiple press releases saying, check your withholdings, check your withholdings, check your withholdings, because they're trying to cover their rear ends right now, right? Okay, this is a problem. This is an unintended consequence of a really good idea, okay? And this is in fact our #1 concern as we head into 2019 because it's tax confusion. There are going to be people who file their taxes who are curious as to why they now owe when in fact they used to be refunded, or why they owe a lot more. Okay, so go ahead.
Question?
Yeah.
What accounted for that bigger spike in that one quarter?
I don't.
Is there any? Okay.
It just is because we calculate it. I don't know, and we've even talked to a couple of our tax, like our business tax guy and our personal tax advisors about like why that would be. I don't know. We don't know. Could it have been related to midterm election? Yeah, I don't know. but the head of the Treasury is the guy who's in charge of those tables. Okay? So I'll leave it there. All right. All right, so that's our number one concern. It's not our only concern. So let's talk through a couple of these other concerns as we navigate the consumer economy. All right, we got some thumbs up and some thumbs downs. So on the thumbs down parts first, let's talk through that. Student debt is a problem. If anyone's followed our work, you know that we are very concerned about the institutionalization, basically, of student debt, or what we like to call the pre-mortgage of life, okay? The statistic was 1 in 7 people had a student debt loan in 2003. Now it's 1 in 4. That's all adults. It's not just millennials. It's pretty substantial. It's grown by a compound annual growth rate of about 13% per year. Okay, imagine if gas prices did that on you. Okay, so have a little bit of context. Not a great situation overall. Holiday hangovers, this just happens every year. You know, even if holiday goes really well this season, that doesn't necessarily mean that things will go well in Q1. In fact, statistically speaking, going back to 1992, which is as far back as we have the data to run correlations, there is 0 correlation to how holiday does versus the following year. 0, okay? So, you know, there can be holiday hangovers. You gotta pay off your credit card debts, right? We have health savings accounts. This is like the silent consumption killer, I think, in the first half of the year. High deductible HSAs, does anybody have one? I do, okay. Statistically, that might have been about 18 to 20%. In fact, we've gone from about 3% high deductible HSAs in the nation to about 20% over the last 15, 20 years. So what does that mean? That when the year rolls over, right, to January 1st, you have to start paying out of your pocket to cover that deductible again, right? If you're paying on the deductible, that means you're not spending at restaurants. Okay, so that's another thing that's a change. Higher cost inflation, the consumer prices just came out today. Gas prices are down substantially, but if you exclude gas prices, overall inflationary pressures are actually strong, higher. They're moving higher, so depending on how gas influences that, but that's something that we're looking into for the next year. We mentioned earlier the tax refund disappointment dynamic, and then again, looking at the tax withholdings reset. So what happens, right? You file your taxes, and you're disappointed. What's the first thing you're gonna do? You're gonna go back to your employer and say, I need a W-4 apparently, and I need to go reset my withholdings. People are not gonna let that happen to them 2 times in a row, right? So that could also extend a complete opposite effect of what we saw in Q2 this year. All right, I see a lot of nodding heads. Thank you for the nodding heads. That's helpful because I realize I'm dealing with some heavy economic work. Yes, ma'am.
I have a question on HSAs, and I don't know if you guys dig into this much. Are you seeing people treat them more like just as a pass-through account, right? So I go to the doctor, I need to pay up to my deductible, but I grab it from my HSA and reimburse myself, or I'm treating that like my IRA and I'm saving that for retirement?
This is such a good question. We don't know.
No, that's fine. I just didn't know if you've
But
done
you know
it.
what? Let's make a note because I think we can probably dig into that broadly. It's a very, very good question.
So I work with all kinds of people as a financial planner, and what I'm seeing is that if you make a lot of money, you're treating it like your IRA and you're saving it for your retirement. And if you don't, you're just treating it like a pass-through account. Mm-hmm. And so basically, you're just getting the pre-tax money, so I'm paying my deductible, I'm getting it right back out. Mm-hmm. So that was my question about the HSAs and like the down, you know, it's like a thumbs down category. Because I think for most people, it just is a flow through. And it's a very small percentage of the population that can treat it like an IRA, cash flow all of their medical expenses throughout the year and just bank that money and let it grow.
Right.
Yeah.
I mean, I use it as a minor tax strategy myself, right? You're like, $3,900. Okay, let's pull that off the AGI because eventually I'm going to spend it. Okay, so it's a good question. I don't know if we've got a line of sight. I've only recently come to knowledge of this 20% penetration dynamic. So Q1 has like been underperforming for a long time in retail sales trends, for what it's worth. Like it just is always this like womp sort of like moment. It's the most meh quarter ever, and so you have to start digging as a curious group of people as we are. You have to dig into like why is that? I think that's one of. Oh, and the student debt I think is also a key thing. I don't think a lot of people realize this. People who graduated in May, June, right? They're not required to pay that student debt until January. Okay, they have like 6 months of, you know, me time, right? And then all of a sudden January hits and you're like, whoa. And so that's another, you know, that's why student debt like rolls in basically in January. Okay, so something to kind of be mindful of. Okay. Positives, child tax credit's a positive, okay? I think off the top of my head, the value of the child tax credit's about $37 billion. Let's just say that entire amount doubles, right? So we have an incremental $37 billion potentially that could come into the market, right, for potential consumption. But, you know, when you think about where we're already, I feel better about making that as a positive if we weren't so under-withheld right now, right? So we're tracking on that, okay. And then curious your perspective, when we get to Q&A, just be thinking about it. We're looking for, Kayla and I at one point when we were writing this PowerPoint, I said, oh, I feel so negative. Like, is there anything else that we can find that's positive to say? And we're coming up scratch. So, you know, if you've got ideas, we're into them. All right. Let's talk about, so those are consumer trends. Let's talk about a couple like demographic category trends, more specific. Steve was kind enough to remind me that he attended when we talked about millennials. Kayla and I love to talk about millennial shopping behavior and millennial behavior overall. And, you know, we believe that millennial household formation is probably one of the most interesting demographic trends that's going to be impacting the economy over the next 10, 20, 30, 40 years, okay? If you think about just a high level level set here, if you think about the population curve of the United States of America, it's what we call a bimodal distribution or a two-humped camel, okay? And you have boomers on one of those humps and you've got millennials on the other. No one caters to the Gen Xers of the world, that's me, woohoo! And there's only 41 million of us, but there's like 70 plus million of each of boomers and millennials, okay? So that's why it matters. And at the crest of the wave, millennials are 28 years old. So they're just getting into the first job cadence, finding the soulmate cadence, getting a baby and a house and in some sort of order, okay, of that. And that movement towards household formation and living their life is going to influence a lot of consumption patterns. Okay, so what you're looking at here is home ownership, or what we like to think of first-time home ownership. I know we have some realtors, you know, in here as well, and some people financial planning and real estate. What you're looking at is the percentage of home ownership ages 25 to 39 or first-time home buyers. It has been in a steady decline for a couple different reasons since 2006. In 2017, it ticked up for the first time since 2006. Okay, I'll pause on that for a moment. A lot has changed since 2006, right? Like we got 4G LTE in 2012, okay? I mean, just like think about that, right? We had a recession. Okay, there's a lot that's happened since 2006. There's probably 50 million more Chipotles than there were before, right? You know, I mean, just start thinking about what has changed in 10 to 12 years. And it started to tick up. The statistic only comes to us from the Census Bureau once a year. It will be updated again, I think in May, June, something like that. We think it will actually hold, even though you'll see a lot of articles that speak to the contrary. We actually think you're going to start seeing it hold. And that is probably one of the most interesting demographic moves. So, all right, I'll just cut to the chase. We think restaurants are at risk. Restaurants, leisure, discretionary.
That was one of my questions, if I could jump in.
Yeah.
$15 an hour to kill.
Yep. Restaurants are at risk, and they have just been benefiting off of just this glorious discretionary dollars of no kitchens and shared kitchens when you've been renting, right? Like who wants to put their groceries, if they even buy them, with any of their friends, right? I mean, you don't. You just go like, I'll just go to Chipotle, right? But the moment you buy a home, the moment, all of your priorities shift. It has to, because you have a pre-mortgage and a real mortgage now, right? So you can't just walk past your Ninja coffee pot and go to Starbucks. It's not gonna be in your budget. You're gonna be like, that's 25 cents a cup, right? Or 20 cents a cup versus $5 a cup. I'll go with 20 cents a cup. Because $60 for a meal or a night out is like a week's worth of groceries at Aldi. Okay? So we're very like pro-grocery, a little cooling on restaurants. These are unpopular statements, by the way, in the marketplace. Okay? But it's not investment advice. All right. And so what you have here is a perfect inverse relationship between restaurants and home ownership. So if you just cut the slice of home ownership changes between 25 and 29 years old, and you look at that relative to overall restaurant sales, it's a perfect inverse correlation. We're not crazy for making these statements. It's actually statistically significant. Okay. But you probably won't be talking about the demise of millennial shopping and restaurants around the holiday. In fact, you're going to have people who bring up things like the stock market, right? And so we want to at least engage in the conversation of what we see right now, right here, right now, because it's obviously moving the market. All right, so this is kind of what holiday table talk has probably looked like over the last couple years, right? It was the election. 2016, that was fun. Remember that? Yeah, that was fun. And then Bitcoin. I mean, I can't tell you how many 18-year-olds asked me about Bitcoin. They're like, should I invest in Bitcoin a year ago? And I was like, the fact that you're asking me tells me this thing is a short, okay? So that was last year, true story, Bitcoin, right? This year it's gonna be stock market. And that's a little bit more difficult to talk about. If you think about it, Bitcoin's kind of a binary conversation. You're either like, it's real currency or it's fake, right? Or election, you're Democrat or Republican, right? But this year it's a little bit more difficult. Stock market, right? That's going to be the conversation. And the two things that are moving the stock market most over the last couple of weeks have been interest rates and tariffs. So we're going to talk about that. And I realize I'm with a savvy crowd, but I don't assume that everybody knows everything about how these things work. So I'm going to bring it down to a very simplistic level. And then we can bring it back up if we need to, but I think it's important that we're all completely on the same page about how this works. And if you're super savvy about these things, maybe we'll just offer you a construct as to how to talk about this with your family, right? And younger people in your life, okay? All right, so banks do not actually physically print money, right? They make money by lending money. We like banks. We like banks because they support things like Club E and community events and what have you. Banks are not bad, banks are good. But they don't actually physically print money. They make money by lending money. But where do they get that money from? Right, customer deposits, right? Things that we have in our bank accounts as they're waiting to pay, we're waiting to pay bills. And we get paid a money rent. That's what I like to call interest sometimes. It's a money rent, right? It's 2% of, that's what the banks have to pay me to keep my money. These are just examples. Don't quote anybody on like real-time interest rates, okay? You see where I'm going. All right, so then they take my customer deposits and they go find businesses to go lend to, right? Or other consumers, but let's just say it's businesses. Perhaps you're in the broccoli business. You need broccoli farming equipment or broccoli seeds, right? So you need to go get a loan for your broccoli business. And with that, you agree to pay them back plus another set of interest, which is, let's say, in this case, revenue of 4%. So the bank is making 4% off of the loan for the broccoli business. They have to pay money interest rate over to someone else for 2%, and ultimately they make their margin of 2%, right? 4% minus 2% equals 2%. That's how banks make money. All right. But what happens when that borrowing rate equates to the lending rate? They don't make money. If you've heard the term flattening yield curve, inverted yield curve, it's because that equation is cattywampus. That equation is out of whack. That's what's going on at a very high level between the interest rates. And when you've got your lending and your borrowing rate essentially meeting and at parity, and you're like not making any money if you're a bank, that's not great for a couple of reasons. One, has actually signaled recessions in the past. Depending on which interest rates you're going to look at, you'll hear people say it signals 7 times, 8 times, 9 times. It signaled recessions in the past when you get that parity, that 0%, okay? So that's one reason why the markets get all rocked up about interest rates. The other thing is, too, that historically it's been a sign of the end of a business cycle or the end of an economic cycle, like a maturity sort of signal, too. So it's not just about the recession, it's just been also a signal around maturity. So it's like, well, on the one hand, we could be maturing, not great. Or on the other hand, it could be a recession, not great. That's why the markets have been rocked on the interest rate conversation. Profits for banks go down, the risks actually go up because they're like, oh wait, we need to go find some maybe less, savory broccoli businesses to go lend to, and all of a sudden the last gasp of loans they make are to people who probably shouldn't actually have gotten that money, right? That's what happened with some of the other recessions. That takes their risks up. Okay, that's interest rates. That's what's going on. Hopefully that's helpful for you to explain to others in your family. But here's a real interest rate curve. This is what they call the 10-2. It's the 10-year and the 2-year treasury rates. And this is the spread between the two of them. So looking at that 4% minus the 2%, right? So it's looking at that margin. And when it gets closer to that black line, it means it's flattening. If it goes below the black line, it means it's inverted, right? Flattening, inverted, not great. And every single time you see it go all the way down, then you see some long blue bars. That means that was a recessionary period. So that's what people are referring to, right? Every single one of those US recessions are the long blue bars. All right, we don't know what's going to happen, but just in case, revisit your defense plan, stockpile a little more cash, and as we like to say, it's better to be vigilant and diligent versus oblivious and frivolous, okay? Yeah, okay. All right, cool. All right, tariffs. What are we doing on time? Okay, real quick on tariffs. So much has already changed even this morning, but here is I'm just going to cut to the chase on this instead of explaining all of it. The number one issue is intellectual property and technology transfer, okay? It has nothing to do with American jobs. Kind of a little bit indirectly, but not really. It's intellectual property and technology transfer. So as you're reading the news on tariffs, keep your eyes focused on those sorts of verbiages, because if we can solve intellectual property protection and technology transfer, then that's ultimately what's going to be a beneficial situation to an outcome. And I've been to factories in China, entire factory cities, as part of our job and career. I will tell you the Chinese never want to impede commerce. They need factories to keep moving. And President Trump needs to talk about trade. And how I know he needs to talk about trade is, whatever his Twitter game is, he's extraordinarily consistent actually in his speeches, okay? We've analyzed his speeches, some State of the Union last year, his joint session before Congress, his first joint session before Congress, and then of course his inaugural speech. And he remains extraordinarily consistent in his message, okay? What he's looking for, jobs, factories, American industry, American workers, immigration, trade, that was from his inauguration. State of the Union last year, jobs, stock market, tax cuts, trade. So what's he going to say this year, right? That's how you know what he's going to be driving to, because he's a pretty consistent guy. He's going to have positive things to say about jobs. That's great. He's going to have positive things to say about wages. That's great. He's losing his battle a little bit on the stock market, right? That's why he's pretty focused on it. He likes to talk about it. And it's also why he wants to have some positive commentary around trade. So, however politically charged things can be sometimes in the nation, the reality is economics and policy go hand in hand. It's better to be as independently minded as you possibly can to understand where things are headed. That's what we try to do. But that's how you're going to navigate the consumer economy in 2019, carefully, okay? All right. All right, I'm Neely, this is Kayla. Thank you for inviting us today, but we'd love to take whatever questions or what's on your mind in our final sort of minutes. Yeah? Yeah?
So the millennials, the two humps, the hump on the right.
Yep.
So yeah, the purchases of boomers being, big houses, suburbs, that sort of economy, Best Buy, TVs. I know it's not financial advice, or a disclaimer, but I'm seeing a pretty different pattern emerging of renting and Ubering and and smaller is bigger in travel. Are we just trading behavior but the same amount of money? What do you think?
I think as they buy a home, it'll change those behaviors and choices. So what you've seen towards pro-travel, right, and pro-multiple Ubers and right, like what we're trying to be out there with is, as they buy a home, they have not only just their mortgage, but now a pre-mortgage, and that will absolutely constrain their ability to spend frivolously. And we have a whole body of work, we shared it last year, where millennials really are pretty wired to be pretty frugal and financially anxious. And so our message to businesses that cater to them, which is our primary clientele, is really to think through the lens of assurance, because assurance is the antidote to anxiety. You know, not Uber, not travel, knowing. They want to know, right? They don't want to be duped. So things that allay their financial anxiety. Yeah. Back here.
Piggyback on that, can you talk a little bit about the values of millennials and how that might impact their spending? Meaning like the charity, right? Like if it's more charity based, and so as we're thinking about interacting with millennials, is there like a framework in which maybe...
Do you want to speak on behalf of 72 million of your friends?
I think what she talked about, they are frugal, but frugal consumers still consume, and so they just have to prioritize it differently. And I think that charity and values is a part of it, being, you know, environmentally friendly for things and where things are sourced from and where they're coming from. I think that just is part of their decision-making process as they prioritize their time and dollars.
So they don't trade, they don't trade on those things when it comes down to economics. They're not gonna start to maybe get something that's maybe less green in order to save some dollars as they get into more financial commitments?
I don't think so. I mean, because you can go to Costco and get everything like organically sourced, and, you know, and they love Costco. So I think that they just find ways to work it into their budget and buy things in bulk, or use Thrive, or they find ways to make it work within their budget, and then maybe that means they're giving up other things, but I think that they continue to prioritize those values.
Your question right here.
I'd like to, excuse me, I'd like to ask my question and then illustrate why I'm asking it. Are you seeing major employers and mid-sized employers doing anything to help re-educate the 40, 50, 60, and 70-year-old employees? GM is laying off 14,500 people, but they could be, due to this Harvard review study, they'll hire the same amount, but they're hiring software engineers, laying off mechanical engineers, they're hiring the designers and the electrical specialists versus the sheet metal workers. And so with this transition to electric cars and green stuff, are those people realizing they've got a hardworking group of people, and are they going to re-educate them? Are you seeing anyone investing in that?
Such a really good question. I'd say, just to give you a little bit of insight as to what is on our docket for 2019 in our research practice, we're tackling big categories like the cost of food over the next 10 years and how food works. We're tackling healthcare costs, right, as well, and labor. We're very focused on labor because we like to say it's super simple, but the consumer is first the labor. You know, you don't have a consumer without a labor, right? And our economy, especially economists, like really like to just like keep them in separate buckets, and like it's the same person. So it's a consumer issue for us to study that, is my point. And I have, you know, aging parents, you know, who are in that category, and my dad used to basically run an entire, you know, CIO sort of situation, and, you know, watching him like still try to figure out what he needs to be doing. And I think we fundamentally believe work is good, you know, that it's not bad. It's good to exercise your brain. It's good to exercise your relationships. So there's a lot of layers into that. I don't know what the answer is, but I believe in us as a nation to figure that out. I don't actually think we're gonna just like roll out and just have this like forgotten generation. I think we're gonna figure that out, and I don't have a perfect answer for you, but know that we are thinking about those things too, and we're studying them, because it's a matter of our economy. 2/3 people, 2/3. You know, we need those boomers to be engaged working and laboring if we want to have them consuming. So it's a good question.
So speaking of the 2/3 consumption, have you been looking at like what proportion is fueled by debt? So our credit cards, like is the consumer debt also ballooning? Like is it being actually, is it wages and then we're taking home more of our paychecks because the withholding got adjusted? Or is that also that piece of that growth, that new 6.5% number was larger, right? That $27, $28 billion number is larger than the $23 billion number. Is that also because consumer debt levels are increasing?
Not enough to be meaningful enough. The most meaningful thing is that withholding change, which is why you can see like it's like $23 billion, right, of a change within one period, defined periods. We do actually track all household debt. And I think overall credit card debt has actually been fairly stable or even like down because millennials really don't use it. They're more debit card users.
And student debt is now the second largest class of debt behind mortgages.
Right.
So it's
So
ahead of
it's
credit cards now.
Yeah.
Which you think
So-
of how many people have credit cards versus how many have gone to college.
Right. I mean, it's 1.4 trillion in size. Mortgages are like 7 or something like that, right? And credit card debt, and then autos, right? I mean, or something like that. It's something to that relationship.
But it's been basically stable. It hasn't been
I think it
increasing.
has been actually fairly stable. There's been some rise in delinquencies, right? Which is why those interest rate conversations get interesting. But over here, yes, sir.
Yeah, very interesting talk. Thank you. Do you have an assessment about the technology impact the economy, specifically about those automations, robotics, or artificial intelligence, both short-term and long-term impact?
I don't. Although I have to tell you, I'm very interested in hoping that I get one of those iRobots underneath my Christmas tree this year. Okay, so if anyone's looking for last-minute ideas. I do believe in automation and robotics. And I mean, even Walmart has been testing it even within their stores and cleaning floors, as well as, you know, we've got the Kiva systems, which back up the entire Amazon infrastructure that does all the long tail sort of picking for them. I mean, absolutely, I think automation is part of our future, but we haven't done enough work to answer that well to tell you exactly how much. I mean, I've read some reports about what people say, but we don't, just because we read it doesn't necessarily mean we believe it, right? So, but it's all part of that labor conversation that we're hoping to tackle kind of in this next year. It's an important thing.
So if you do, if you do analysis in this area, what would be your approach? Do you look at historical, like the industrial revolution? How do you approach such?
I think we would actually approach more what could be automated, and then like looking at the ecosystem of who's doing what in what stage of development. I believe there's value in looking back to look forward, but the type of analysis we would approach would be more of. So we might take a single category, like food, for example, right? And just say, within food, what could go towards automation versus not, right? It's very valid, though, very valid, and definitely top of mind. Definitely top of mind. Yes, Peggy?
So do you see any innovation in banking so that they can increase their net interest margins so that they could have a more premium price loan to a less risky consumer or to a less risky business? So like packaging things in with their lending so that I'd be willing to pay that premium price because I get something else from it.
I haven't, it's not high on my awareness screen. But I know that net interest margin is like the hot topic right now. And what I would need to like weigh in with all of that is just a broader conversation around there's some concerns about the erosion of corporate debt broadly right now, like in just how over corporate debted we are. Because even though there could be something fun and packageable there, like there might be this looming issue right around the corner that's behind us that's gonna have a much bigger impact, right? So I wouldn't wanna have to answer that without answering that whole picture. Kayla and I did have the privilege of presenting at the Turnaround Management Association early in 2018. These are basically like, and I mean this reverently, like they're ambulance chasers of like bad delinquent debt, okay? And we presented a little bit about what we thought was gonna happen with withholdings, and let's just say we were some popular gals. You know, my friends in that little world are talking some more negativity in our ears around what's going on with corporate debt right now. So, all right, we're good. Thank you so much for your attention today. Appreciate you. Thank you.